metrics thus far, and what the Fed has been talking about with Jerry Yellen is, we probably hit the targets the Fed would have gone in November if it weren't for right in front of the election. The 96% odds that the Fed's going to go, you've hit. I mean, the employment dynamic, inflation is tangibly accelerating to their goal, in fact, in a number of metrics through the 2% target. So it's time to go. By the way, it's 25 basis points on the front end of the yield curve. They should have gone a while ago. We're ready to go. And so I would say with great certainty that they're going to be going in December. And then the trajectory, and I think in 2017, if you follow the dots, it's probably 2 moves in 2017, but they're going to watch the data. They're going to watch the fiscal transmission for sure, and how the economy is responding as a result.
So Jonathan says correctly, the FOMC has a lot of uncertainty. You do as well. People who are investing in bonds have a lot of uncertainty. How do you position yourself? You don't know what the Fed's going to do exactly. You don't know what's going to actually go through Congress and get done by the government. How do you position yourself so you don't take a bath if you're owning bonds?
So I'd say a couple of things, and we've talked about on this show for a number of months now. Something has changed, and by the way, it didn't change in the election. I actually think it pushed it to a whole new gear. In September, so I think it was September 21st, when the Bank of Japan talked about letting the economy run hotter, letting inflation run hotter in Japan, and then the Fed, the same day, later that day, talked about let the economy run hotter 3 times. Chair Yellen talked about it. The paradigm has shifted in terms of inflation, let inflation accelerate, and then you literally pushed it into a new gear. So what do? Long-end interest rates are dangerous. Well, you create a dynamic that you see what's happened since the beginning of September. Long end of the curve is almost 15 points. Yep. I mean, these are bonds. This is not. These are, by the way, AAA securities that are that have had this sort of descent. So what do? You own a lot of cash flow in the front end of the yield curve. Fed's going to be deliberate in terms of how they move, given all the uncertainty. Boy, if you could buy high cash flowing assets in the 2 to 3 to 4 year part of the yield curve and just hold them, that's the way to insulate yourself. Make sure you're being really careful about long-end exposure like we saw this week. And I think that's how you can still generate positive return of fixed income. It's where do you own it is going to be incredibly important.
So you own the short end. You take the cash as it comes off, as they come to. Then what do you do with that cash once you get it back?
Yeah, you try and find more of those short-end assets. Or, by the way, there are assets overseas that still make some sense that are going to outperform U.S. interest rates. So that dynamic is really important in terms of how you're managing, for example, buying investment-grade credit that has a lot of interest rate exposure, but you can use tools to manage the interest rate component of it, and it's being really thoughtful about, I don't want a lot of long-end interest rate risk. By the way, if there's a piece of negative news in the world, the long end of the curve will actually improve, but it's going to be incredibly volatile. It's the front to the intermediate part of the curve that are going to be much more stable. So that's where we like owning it.
But let's talk about this from a sort of global bond market perspective then. So I've charted very quickly 10-year treasuries over bunds, the yield, the spread, the widest since the late 80s, Rick. Now, do I need to look at this chart and say, well, that should cap things because the money abroad should start coming into treasuries, or do I need to look at it on an FX hedge basis and say, you know what, maybe it's still not attractive to come to treasuries yet, given what's happening with the dollar? How do I think about this at the moment?
It's an unbelievably powerful chart. There are so many cross currents. The reason why 10-year treasuries aren't going to 3.5% is exactly because of that chart, because the international demand will still be in there. However, there's an interplay today between that international demand, which will continue to be significant, not just out of Europe, European insurance companies' pension funds, Japanese insurance companies' pension funds. There's an interplay there between that bid and the fact that inflation is accelerating, and U.S. investors who are sensitive to this interest rate move that are reducing some of their exposure. So what wins? At the end of the day, what wins is the dispersion, meaning, and this is part of the argument, U.S. long-end interest rates don't make a lot of sense until you widen that even significantly more. And by the way, the other side of it is you're talking about German rates, which are also too high, and which we think will continue to move higher as the ECB starts to modify their plan certainly over the next few months.
And finally, on this very powerful chart, how much of this is nominal and how much of it is real? Because you're talking about different potential inflation rates between Germany, for example, and the United States as well.
Yeah, so there is, I don't know if we brought it.
We do have a
chart that I'll show you. It's actually both, and it's actually almost perfectly symmetric.
There we go.
Right, so if you take what's happened in the last couple of years, and then you have to go all the way to the last data point, because this is the last couple of years. So what's happened, exactly as you described, real rates have compressed and inflation break-evens have come down. Now you're starting to see both. You can see right at the end, you have to focus really carefully, but right at the end, you see both starting to move higher, and that's actually the right dynamic. Inflation is moving up, and real rates are moving up. So it's literally both that are taking place, and that is the right dynamic going forward, and will be the right dynamic going forward.
Okay, Rick Reeder, you're going to be staying with us, I'm happy to say. For an update on news coming from outside of the business world now, we're going to turn to Emma Chandra. She's here with First Word News. Emma.